In March 2016, Warner Brothers pulled off one of the most ambitious corporate maneuvers in Hollywood history. They put the two most iconic superheroes of all time into a single film for the first time. It wasn't just a movie, it was an event, a financial certainty. The film opened to massive numbers and went on to gross $873 million worldwide. And yet, within a year, it was being described in boardrooms and trade papers not as a triumph, but as a cautionary tale. A strategic misfire. For many, a failure. So, which is it? How can a film generate nearly $1 billion in revenue and still be considered a loss? The answer isn't found in the simple math of revenue minus cost. Any studio can make a profitable one-off film. The real answer, the answer that matters for the future of a multi-billion-dollar franchise, is found in the spaces between the numbers, in the trajectory of the cash, in the cost to the brand, and most importantly, in the economics of lost futures. Today, on Cinema Economics, we're dissecting Batman vs. Superman: Dawn of Justice. We're going to look past the headline gross and find the real financial story. How a technically profitable film can fail at every single thing that actually matters in modern Hollywood. The numbers. Profit versus expectation. Let's start with the basic math. On the surface, it seems simple. The reported production budget for Batman vs. Superman was huge. Estimates place it between $250 million and $325 million. Then you must add a global marketing spend. That likely exceeded $150 million. The total investment was staggering. It was well over $400 million. The film's global box office gross was $873.6 million. This is a massive sum. So, did it make money? According to a definitive 2017 analysis by Deadline Hollywood, yes, it did. The publication breaks down the studio's net profit. They account for all revenue streams and costs. The final figure? $105.7 million in net profit for Warner Brothers. Profit is profit. This should be the end of the story. But it isn't. Because in franchise Hollywood, success isn't measured against zero. It's measured against expectation. It's measured against potential. And it's measured against the strategic master plan. For this film, the benchmarks were astronomical. Industry analysts at the time were clear. Given its cost, the film needed to make roughly $800 million worldwide just to break even. That was the baseline. To be deemed the unequivocal success it was designed to be, it needed to clear $1 billion, easily. That was the expectation. Batman and Superman together on screen for the first time. It was considered a floor, not a ceiling. So we have two conflicting truths. Truth 1. The film was technically profitable. Truth 2. It failed to hit its fundamental financial target by over $125 million. This is the first layer of the failure. It's a failure of magnitude. When you spend franchise money, you need a franchise-sized return. A $105 million profit on that investment is weak. It's disappointing. Think of it as an opportunity cost. The studio deployed its two biggest assets. It spent maximum resources. It occupied the prime release calendar slot, and the return was merely okay. They didn't just need to make a profit. They needed to make a profit so large it would fund an entire cinematic universe. That $125 million shortfall isn't just a number on a spreadsheet. It's missing leverage. It's momentum that wasn't generated. It's a signal to the market. The surest bet in Hollywood wasn't so sure after all. The trajectory. A record-shattering collapse. Now, let's look at how the money arrived. The pattern is everything. The film's opening weekend was enormous. In North America, it earned $166 million. Globally, it blasted off with $424 million. These numbers shattered records. They proved the power of the concept. Demand was sky high. This was the peak of Warner Brothers' leverage. The market had spoken. It wanted this film. Then, something broke. In its second weekend, the North American box office collapsed. It fell by a catastrophic 69%. A steep drop of 50 to 60% is normal for a front-loaded blockbuster. But 69%? That is an emergency signal. It indicates a stunning rejection by the general audience. The fans had all come immediately, and they told everyone else not to bother. The financial life of a major film is in its legs. This term refers to its staying power. How many times does its opening weekend gross does it multiply by? A film with good word of mouth might multiply by 3 or 4. It earns 3 or 4 times its opening number. Batman vs. Superman had no legs. Its multiplier was among the worst ever for a superhero film of its scale. It opened huge and then ran into a wall. That second weekend plummet is a pure economic indicator. It is the direct financial consequence of word of mouth. It translates bad reviews and audience disappointment into lost dollars. It shows that the product itself contained a fatal flaw that the hype could not sustain. The initial gross was just pre-sold demand. The following weeks represent the true market test. The market's verdict was swift and brutal. The film failed to capture the public's imagination. This trajectory transformed the story. The headline changed from "Historic Opening" to "What Went Wrong?" The collapse poisoned the narrative. It turned a commercial launch into a public debate. The financial conversation was no longer about how high it could go. It was about why it fell so fast. That is the second layer of failure. It is a failure of endurance. It revealed a fragile product beneath a powerful brand. The money stopped flowing almost as soon as it started. The catalyst. How narrative choices capped the ceiling. The collapse had a clear catalyst. The film's own narrative and tone constructed an economic ceiling. This is where creative decisions are translated directly into financial results. The critical response was a wall of no. It earned a dismal 28% score on Rotten Tomatoes. For a blockbuster, such reviews don't just influence elites. They shape the broader cultural conversation. They give the hesitant audience a reason to stay home. The film was branded as a disappointment before most people had even seen it. Audience reception was mixed at best. It received a B cinema score. For a big-budget superhero film, this is a poor grade. An A- is expected. A B signals deep dissatisfaction. It confirms the product failed to delight its core customers. This score is a predictor of poor word of mouth, and word of mouth is the engine for long-term box office health. But why? What specific choices caused this? The film embraced an operatically somber tone by presenting a cynical, murderous Batman and a brooding, alienated Superman. This was a deliberate, creative gamble. The filmmakers bet that audiences wanted grandeur and gravitas, but they bet wrong. For many, it felt joyless and more like a lecture. Pacing was also a critical failure. The plot was dense with foreshadowing for future films. It sacrificed a clean, compelling core conflict. Viewers felt they were watching a corporate roadmap, not a story. A confused audience does not become a recommending audience. The economic impact of these choices was direct and measurable. The dark tone limited the film's appeal. It alienated families and younger viewers. The narrative complexity discouraged casual repeat viewings. The film was designed as a dense, single-serving event. It was not built for enjoyment. It was built for analysis, and the market for analysis is much smaller. The product itself suppressed its own demand. The marketing sold an epic showdown. The delivery was a philosophical debate with a messy third-act monster battle. This disconnect triggered the negative word of mouth. That word of mouth is what caused the 69% second weekend drop. It is what shattered the film's legs. The real cost: franchise poison and lost leverage. This is where the isolated profit of $105 million vanishes. Batman vs. Superman was never just a film. It was the foundational launchpad for an entire cinematic empire, the DC Extended Universe, DCEU. Its primary economic function was to create explosive, positive demand for a decade of sequels and spin-offs. But it did the opposite. It became franchise poison. The film's negative reception did not exist in a vacuum. It attached itself to the brand equity of DC's core trinity, Batman, Superman, and Wonder Woman. It didn't just tell a bad story, it made audiences skeptical of the characters themselves. It created a narrative that DC movies are dark, confusing, and joyless. This became a liability for every film that followed. The next film was Suicide Squad. It suffered from frantic, last-minute edits. Why? The studio was in a panic. They were reacting to the backlash against Batman vs. Superman's tone. Then came Justice League. Its entire production was a costly, demoralizing attempt to course-correct. The film underwent massive reshoots. Its original director was replaced. The goal was to artificially inject the lightness that the previous film lacked. It was a billion-dollar universe trying to reverse its own DNA. This is the real cost, the loss of strategic leverage. A successful launch would have given Warner Brothers immense power. They would have had a loyal audience. They would have had a coherent brand. They would have had the confidence to follow a planned vision. This leverage translates to better talent deals, stronger merchandising, and more favorable terms with theaters and partners. Instead, they lost all leverage. They ceded the battlefield to Marvel. They entered a state of permanent reaction. Every subsequent decision was defensive, not assertive. They were no longer building a universe. They were performing an expensive triage on a wounded one. The film also destroyed future earning potential. A thriving Superman franchise was effectively put on ice. A planned Batman solo film with Ben Affleck was scrapped after years of expensive development. These are not just unmade movies. They are lost asset streams worth hundreds of millions, perhaps billions. The modest profit was spent 10 times over on crisis management and abandoned projects. The failure of Batman vs. Superman created a chain reaction of instability. It forced the studio to waste capital fixing problems instead of growing new value.
The final verdict: how to win a battle and lose the war.
Batman vs. Superman's true failure was not financial, but tactical. While the film generated a net profit, it catastrophically failed in its primary strategic function as a universe-launching springboard. The goal was to use the iconic characters to create an unstoppable financial engine for the DC Extended Universe. Instead, the film's reception caused Warner Brothers to lose its offensive market position. The studio's leverage shifted from offensive to defensive. They spent subsequent years and capital on reactive crisis management, reshooting films and retooling plans, instead of confidently building new value. The profit was erased by the cost of repairing the brand. The final verdict is that in the modern era of franchise capitalism, a film's success is not measured by its standalone profit. True success is measured by the long-term leverage and cultural capital it secures for the future. Batman vs. Superman proved that you can win a short-term financial battle and still lose the long-term strategic war, making it a definitive case study in high-stakes Hollywood failure. If you'd like to apply this analytical framework to another film or Hollywood case study, I can help develop a new script structure for you.